My name is Joshua Heatley, and I am the Governor of the Kristin Monetary Policy Team. Today, our decision is to reduce the OCR by 25 basis points from 1.75 to 1.5%.
Domestic inflation expectations are pertinent in our decision to reduce the OCR to 1.5%. Raising CPI inflation to the PTA target midpoint of 2% requires minimising variance in economic activity and unemployment. Current inflation expectations in the domestic economy are low at around 1.4%. This is mirrored with some low inflation in tradables. Combined with current wage increase rates below 2%, this means that the CPI ex tobacco and petrol remains well below the target midpoint. With potential growth in the domestic market exceeding inflationary expectations, a high rate of inflation in non-tradables is necessary to stimulate the domestic market. A relatively flat Phillips curve relationship means that we need to see a positive output gap to offset low expectations in wage growth, which will in turn drive up non-tradable prices. A need for increased rates of economic activity to cause inflationary pressure requires additional monetary stimulus, necessitating a 25 basis point cut.
With the recent slowdown in GDP growth, we expect to see continued softening in the employment rate, resulting in lower employment growth and lower wage inflation. Conversely, employment remains near its maximum sustainable level, and the underemployment rate at 11.3% is at a 10-year low. Additionally, the output gap is close to zero as illustrated on the diagram, and capacity pressure is expected to build in the medium term. Net migration is relatively steady, in line with the numbers we have seen over the past 5 years, keeping the rate of population growth high while competition for resources continues to restrain investment. This, combined with the government's planned infrastructure expenditure of $6.1 billion over the next 3 years, will stimulate growth but may itself be constrained by the availability of resources. Consequently, we are cutting the OCR to 1.5% to support our maximum sustainable employment objectives. This is prudent to underpin the outlook for growth and employment in the short term.
An overall weakening in consumer and business confidence acts as an indicator for us to lower the OCR from 1.75 to 1.5%. Pressures are being placed on firms by calling GDP, suggesting total output is falling, which appears persistent. Lower consumer spending acts as a direct cause for slowing GDP through factors of decreased house prices, increased immigration, and increased fuel prices. The softening of housing is offset by a strong labour market, in which consumer optimism still exists. Lingering uncertainty in current fiscal policy is limiting business confidence. A net 47% of firms expect higher costs, likely due to the minimum wage increase. Key indicators from the April ANZ Business Outlook survey suggest that business confidence is flat, with a net 38% of respondents reporting that they expect general business conditions to deteriorate. In addition, profitability and investment expectations lifted slightly, but continue to remain bearish. Therefore, the OCR declining to 1.5% will allow for economic stimuli and increase the likelihood of achieving the targeted midpoint inflation rate of 2%.
A part of our decision to cut the OCR has been due to a softening housing market. Housing and utilities make up 25% of the CPI, and house prices are a significant governor of consumer spending. Overall house prices increased 2.6% this year, compared with 7.3% last year, and house prices in Auckland came down 1.5%. Continued high prices are reducing house price inflation, and the foreign buyer ban, combined with banks loaning more restrictively, is limiting the number of buyers. Overall, housing inflation is now reduced to become more sustainable. This means that the housing market is no longer placing the inflationary pressure it did previously, contributing to our decision to decrease the OCR to 1.5%.
Part of our decision to reduce the OCR by 25 basis points to 1.5% is the current uncertain and political trade terms abroad. New Zealand's status as a small trading nation means that it is particularly susceptible to international headwinds. In 2019, global trade volumes have significantly slumped, with annual trade growth at its lowest point since the GFC. As China, our largest trading partner, sees softening growth, demand for New Zealand goods is expected to decrease. While slowing economic activity is not expected to impact primary sector returns in the short term, there remains a risk in the long term, with global demand fragile. Meanwhile, in the tourism industry, forecast profits drop significantly as visitors from China are down almost 6%. International headwinds, combined with a general easing of interest rates abroad, indicate that the central bank should cut the OCR to 1.5% for the near future as the impacts of this become apparent.
Based on the domestic inflation and employment outlooks, as well as increasing international uncertainty, a 25 basis point cut is required to support sustained economic growth, with potential further cuts.